We still got a few folks, jumping in here, but everyone, welcome to Beyond Bills. Give everyone another moment or two. All right, looks like the attendee list is starting to grow. So I'm going to go ahead and kick it off here. Welcome to Beyond Bills, leveraging accounting, finance, and insurance for growth in 2024. Our speakers today, Doug Bend, owner of Bend Law Group, Josh Butchness, the vice president of partnerships from Founder Shield, and Cole Levin, who leads our professional services CFO team here at Pilot. Now, today, what we're going to jump into, here are a couple of quick topics. But before we do, Pilot is the largest accounting firm in the U.S. for small businesses. Our team of full-time U.S.-based accountants and bookkeepers, CFOs, we take the work off your plate, and the CFO team helps you run a more profitable firm. So business owners trust us to deliver reliable financials to them every single month so they can have confidence in the decisions that they make. Founder Shield is a digital insurance platform dedicated to creative and seamless, intuitive, responsive ways to help clients grow. They have a re-engineered insurance experience with smart applications, bespoke coverage, and proprietary policy management tools. Since both of our companies work with literally thousands of small and growing businesses, we have a unique snapshot of what's happening in the market, and I'm excited for us to be able to share that with you as we looped in our expert here, Doug Bend from Bend Law Group. I'm going to pop off video here shortly, let the experts take over, but I'll be monitoring the Q&A, and we'll kick off a chat a little bit later. So Cole, I'm going to go ahead and pass it over to you.
Great. Thank you, Jake. Hello, everyone, and welcome to our roundtable discussion covering finance and insurance for growth for law firms and professional services alike. My name is Cole Levin, and I lead the professional services practice for CFO services here at Pilot, where I'm an outsourced CFO for early stage and scaling businesses. I'm thrilled to be joined today by Josh Butchness from Founder Shield and Doug Bend from Bend Law Group. Now, before we jump in, I'll let you both give us a brief introduction about yourselves, your role in helping small business owners, or in Doug's case, how you are a small business owner.
Yeah, thanks, Cole. My name is Josh. I've been with Founder Shield for the past year now, heading up partnerships with them. So we've been working with a bunch of accelerators and VCs. But prior to that, I was consulting for small businesses. So I spent 7 years helping people scale and understand what they're best at and what to kick out to other people.
Well, great. Well, thank you for having me today. I appreciate it. I started Bend Law Group back in 2010. We're based in San Francisco. We haven't fled yet. We're still here. We have 7 full-time attorneys at the firm. We serve as outside general counsel for entrepreneurs. We do everything from launching 50+ companies a year to contract drafting and reviewing to raising capital and hopefully having our client have an exit.
Thank you both. So let's go ahead and get started. Now, running a business is no easy task. Getting your first clients, making your first hires, and standing up the processes that make how your business operate are challenges in their own right and can frankly be overwhelming. We thought it would be beneficial to help break down how to run your back office into more manageable steps. Today, our discussion will cover 3 key areas of management for small and early stage businesses. First, we'll discuss when and how to get your financial processes working to increase both profit and sustainability. Second, we'll discuss risk management through various stages of growth. And third, we'll discuss compensation structure and benefits planning for both partners and employees. So I anticipate that our discussion will raise many questions, and we can't cover everything in this session. So please feel free to drop them into the chat, and we'll make sure we'll leave some time at the end to address as many as we can. So let's go ahead and kick things off, and let's talk about some trends in the professional and businesses services industries. First, 50%. 50% of all businesses in this space fail within the first 5 years. This means that managing your finances and risk could not be more important, particularly in the early stages of your business. Second, professional services is leading all industries and current job openings. And we expect this means accelerated hiring in the sector. So we'll walk you through the ins and outs of growing your headcount and compensation planning the right way. And third, we see more and more outsourcing we see more and more firms outsourcing the accounting and IT back offices. As an outsourced CFO myself, working for a bookkeeping company, I get asked all the time if outsourcing is right for your business. So I know this is something near and dear to Doug's heart because this is what he went through many years ago. And so if we flip over to the next slide, let's jump into some of the financial processes. Doug, what were some of the key financial processes you set up when you started your firm? And how did you know when the time was right to hire outsourced support?
Well, I think in hindsight, I waited too long. So the first, I made two big mistakes, I'd say. The first mistake was that for the first year, I did my own bookkeeping, and that was a mistake for a few different reasons. I'm not a good bookkeeper, pretty good attorney, not a good bookkeeper. I think a lot of attorneys are like that. There's a reason why we're attorneys, we're not great at math. And so a lot of times it would fall on the weekends, fall late at night. So one, I was doing it at a time where it would make me not very happy doing it on the weekends and doing it at night. And two, you really should outsource not only bookkeeping, but everything you do for your business to other folks that can do it better and for lower than your hourly rate. So you should focus on what you're great at, focus on doing the law, have bookkeepers focus on doing the bookkeeping. So the first year I did my own bookkeeping using Excel. Really, that was not working out very well for me. And so I moved on to having a bookkeeping firm do our bookkeeping after the first year. And then the second mistake I made was the first bookkeeping company I hired was a general bookkeeping company for business owners. And law firms are a different beast. We have attorney-client trust accounts. It's a whole other layer of complexity to that. And that bookkeeping firm became pretty clear pretty early on. They weren't the best fit for us before finally hiring a bookkeeping firm that does specialize in helping out attorneys that really are the best fit for helping us out with the books.
Yeah, and complementary to that, we're bad lawyers, but bad bookkeepers, so we can fill that gap. One thing that I recommend for early stage businesses is really three fundamentals of why bookkeeping matters. And it's also really the core of how your business continues to operate. And those are getting paid, paying your people, and filing your taxes. And these are really the three core operations that you need to make sure you have under control at all times in your business. And that's supported by having a bookkeeping team, an accounting team. And having the books under control not only are important for internal management, of course, you need to know how your business is performing, but it's also for investor relations and board reporting. And we have clients come in all the time that thought books were just needed for year-end tax and really didn't give it much consideration until they were mandated by the IRS or their state. And we end up having to kind of urgently figure out how to get their accounting in order for them. Because if you're trying to go to a bank and get a loan, the first thing you'll need to provide is your finances. And so having these kind of ready for you at all times is really critical to making sure that you're prepared, both for internal management, but also, like I said, anything that comes up externally that may require those finances. Very important to have them in order at all times.
Josh, one of the things that I had found challenging when I first started my law firm was knowing what insurance coverage I needed right out of the gate. What insurance coverage could I maybe wait on? And I think it's really hard for new business owners because when you first get started in business, everything's coming out of your own pockets, coming out of your own savings. And so it's hard to make that investment in good bookkeeping. It's hard to make that investment in having insurance policies that help out your business. I was hoping you can help me let me know and other business owners know that what are really the critical insurance policies that you recommend clients have from day one right out of the gate?
Yes, so there's two that I think that are really important. E&O and cyber. E&O is also known as professional liability. And then cyber insurance, obviously, covering threats based on your data. With the E&O, even minor mistakes, your clients can claim malpractice, and a lawsuit at this stage can really cripple your business. So it's really important from a time and money standpoint that you have some protection built in there. From a cyber insurance standpoint, you could have a breach of data, especially, depending on the type of clients that you're working with. You're handling sensitive material. So you're just a high risk. So those are really important. And then, also if you're in a physical space, then obviously general liability is going to be important for your basic coverages.
It strikes me, I think, E&O insurance, professional liability insurance is important for attorneys anywhere. There's an additional reason, at least in California, to have it. California has a relatively new requirement that they passed in the last few years that if a law firm does not have professional liability insurance, you're required to disclose that in your engagement agreement with the client. It's a section saying we don't have liability insurance. And so, of course, that doesn't look very good. If you have that in your engagement agreement, I think it sends the wrong message to potential clients of, are you a real law firm? Do you take your business seriously? And frankly, if you mess up, how am I going to be covered for those types of damages? So I think professional liability insurance is important anywhere, but particularly in California, where if you don't have it, you're required to disclose that in your engagement agreement. So an additional reason to have it in California is it's almost like a marketing expense where you don't have to make that disclosure to clients, so you don't have it. That really doesn't get you off on the right foot.
Yeah, absolutely, completely agree. And once you have the fundamentals in place for insurance and accounting, what are the next steps that you'd take, Doug, to get more control of your profitability?
Yeah, for me, it was having monthly snapshots from our bookkeeper. And so every month we get reports from our bookkeeper, and the report has not only the law firm's overall expenses and revenue generated, but also a report for each individual attorney. And why that's helpful is that it shows, what types of expenses is that attorney incurring for the law firm? What types of revenue is that attorney bringing into the law firm? And it kind of gives you a snapshot of how they were doing in that month. And if you see a drop off in an attorney's production, it's a good time for you to kind of check in with them of, how are they doing? Are they not getting the type of work that they want to get? Are there things we can do to help make sure that they get their revenues numbers up? So for us, it's that monthly report from our bookkeeper. And one of the key things I really like about those reports is it often includes a side-by-side with the prior year's revenue in that month. So we can see how did we do in February, not only in 2024, but 2023, to see, hopefully, are we on the upswing? Is revenue increasing? So it gives us a kind of a comparison last year versus this year.
Yeah, and with our clients, we look at a lot of the same things, Doug. So you mentioned utilization. That's definitely a key priority for us and for any professional services business. We're looking at profitability at an individual department and sometimes even a project level. And you mentioned, kind of the importance of what we call budget versus actuals variance. It's only so good having, the analytics if you really have nothing to compare them to and have a good sense of how you're performing against what it is, you're planning to do. And it really allows you to kind of open up the areas to see where you're missing, where you're exceeding, and use that to kind of create a plan on how you'd address some of the gaps that you're seeing. And just to kind of highlight the importance of being able to actually analyze your business at a more granular level than, just what your profit and loss statement might allow. One of the clients that I've worked with in the past was a moving company that actually had multiple services they offered: long haul moving, short haul moving, local moving. And we found the company was losing money in aggregate, but we weren't really sure what was happening. And what we were able to do was actually open up each of the different product segments and analyze in isolation, what's the profitability on each local move, what's the profitability on each short haul, and what's the profitability on each long haul. And we're actually able to discover they were only profitable on the long haul moves. And so we actually had to go in and understand, why it is that they were losing money. Are those business services that we want to continue to offer? But it really kind of gave us the tools to see on a service by service level, or department or even individual level, where are we making money and where are we losing? And that's really critical for a business to understand where their profitability is coming from. Now, analyzing past performance and doing those sorts of analytic tests are critically important, but one of the key areas of focus for my group is also forecasting future business performance. And Doug, are you working with business forecasts?
That's something I could really do a much better job of. And I think we get the monthly snapshot, but in terms of where is the revenue going, when is it a good time to hire a new attorney to kind of project where that revenue is going? That's not something we're currently doing. And I think it would be really helpful for us to have that as a law firm. I think as attorneys, we get caught up so much in the day-to-day, clearing out the inbox and whack-a-mole, putting out fires with our clients. But, if you're running at 1,000 miles an hour in a certain direction, if you change course even by a few degrees on your compass over time by having more strategic planning, it can really have a dramatic impact on your end destination.
Yeah, and I couldn't agree more. One of the things that we look to do with our forecasts is not only create kind of a baseline forecast, but also look at various scenarios. So looking at different revenue scenarios or different hiring scenarios and seeing those impacts on cash and, do we have, are we well capitalized to the point of being able to hire in advance of new projects coming in or new revenue? Or, what does my end term profit look like if I do make certain hires and can, acquire a certain number of billable hours for each of my attorneys? And, one example comes to mind of working with a digital transformation firm that was a consultancy. And one of the things they were looking to do was build a sales team, but they really weren't sure of the economics on the sales team. Would the new potential revenue growth outweigh the cost of the teams and the commission structure? And what we're able to do is actually really model out various scenarios of how effective and how big this team would be, what the cash requirements would be initially to fund the payroll for the team, and ultimately what the net profit would be to the business based on different scenarios of kind of the throughput of this team, and seeing if it made sense even in a low throughput scenario to hire this type of team, and sort of what the upside potential could be with great output. And so putting these forecasts and allowing ourselves to scenario plan really gives us kind of clarity into all different outcomes and be prepared for all different outcomes, and also really test different business processes and changes to see how they'll affect the ultimate business in aggregate. So let's keep on this path of scaling and planning for growth and being prepared before you grow, which can help you avoid some painful pitfalls, not just financially, but legally as well. And as a firm starts to grow, not only in revenue, but breadth of operation and, of course, number of employees, Doug, what are some of the ways that a business can protect itself?
Well, I'd like to think about it as in 4 layers of protection. And the first layer of protection is customer service. And I think business owners should err on the side of comping time, comping product, whatever it might be. Sometimes that's very hard to do, particularly if you feel that the client or the customer isn't right. But the amount of lawsuits that can be avoided by good customer service and one, admitting that you made a mistake if you made a mistake, apologizing for it, and trying to make it right really can prevent a lot of litigation from having, and that person not going to a barbecue that weekend and complaining to an attorney about what happened. And the next thing you know, that attorney says, hey, we should file a lawsuit, right? So really try to err on the side of not putting your head in the sand, but acknowledging the problem, trying to make it right. So I think that's the first layer of defense is customer service. And sometimes you change those negative potential reviews and the 5-star reviews as well. So it's also a good marketing expense as well by doing that. The second layer of defense is hopefully a good contract, whether that's terms of use and a privacy policy for your website, your app, if you're an online software type business, or if you're a service provider having an engagement agreement or a services agreement with your client that makes it clear that the allocation of the risk that if this happens, perhaps there's a limitation liability provision in that contract to cap your potential exposure from that incident. So hopefully you have some sort of contract in place with the client, with the customer to protect yourself. If the customer service doesn't work out, they say, hey, look, I'm still not happy. I'm thinking about suing you. Well, if you take a look at your contract, I'm sorry you feel that way, but you're really on the hook for that instead of us, or we're limited in the amount of liability that we have. The third of the 4 layers of defense is having maybe some sort of legal entity in place. And so, if customer service doesn't work out and the contract doesn't protect you and you lose a lawsuit, well, hopefully you have some sort of liability shield in place between your business activities and your personal assets by a legal entity. So that's an important stopgap, if you will. And then lastly, insurance. Insurance is a big part of that. And it's not only to help cover you if there's some sort of damages that arise in the business, but hopefully that policy also covers your legal expenses. It can be very expensive to defend yourself, even if you're right. So you can spend a lot of time, a lot of money fighting a lawsuit, and you win that lawsuit and the plaintiff loses. But if you're out a lot of money in attorney fees, if your insurance policy doesn't pick that up, that could be a real hurt to the business. So I think insurance is a really key component to protecting the business as well.
Yeah, we've been itching to get to this slide. So let's break it down. We can kind of break risk down into a few different categories. So we want to talk about them in physical exposure, employee exposure, and professional exposure. Let's talk about when you need them. So from general liability, if you have a physical space is when you're going to need general liability, but also depending, you may have an all remote team. But if you sign a contract with a large client, they may require you to have general liability, and it just kind of really solidifies you as someone that's doing proper business in their eyes. So there's no particular reasoning other than it really helps them understand that you're providing your own coverages, that you're a legitimate business. If you do have your own office, if you have a physical space, then obviously you'll need that for any maybe bodily injury or things like that. And then with the employee exposures, workers' comp, and it's probably going to be the first one that you'll come across, right? So unless it's a group that's an LLC and you're all K1 employees, you're going to need workers' comp because you'll maybe have junior associates, or you're going to have people working in your office that will get paid. So you'll need to be providing workers' comp for them. Employer practice liability is also something that, as your business grows, once you get to about 10 employees and you're bringing in people that maybe you don't know as well as the 3 people that have founded your firm, you're going to want to look into this because it protects you against harassment and discrimination, not only from your employees, but even when you're interviewing employees. Like, a lot of people don't understand that can be part of the process, that maybe you didn't hire somebody because of ageism or something along those lines. And depending on what state you're in, that there's very different attitudes towards employees, and some states are very employee friendly. So I really recommend, if you're in California or New York, that you're looking into these types of coverages. And I'll just touch on crime quickly. Like, if you're taking in large sums, and if someone on your team is doing your books, there's always embezzlement it could be a problem, right? So crime can help with that. I don't know that it's a necessity right away, but as you're growing your business and things are getting bigger, especially if somebody else isn't looking out for you, the way that Pilot may be, it's definitely something to consider. And then finally, the professional exposures. We touched on this a little bit earlier, how important, air and emissions professional liability is, as well as cyber. You want to jump on those things immediately, just to really, protect your business and how you're going to grow and scale. And now that we have, risk under control, let's talk about growing your firm, compensating your employees, retaining that top talent, how important that is to the firm. Doug, what tools do you use to make sure that your employees are compensated fairly, and what motivates them? How do you help them grow and benefit them by performance?
Yeah, we've experimented with a few different models. The traditional law firm model is that the attorney's bonuses are pegged to the number of billable hours that the attorney bills to clients. And for me, we do something a little bit different. And the thought process is that more important than the number of hours you bill to the client, how much of that time is actually being paid for. And so if an attorney bills a ton of time to clients, but the clients don't feel they're being billed fairly, and they don't pay those invoices, or a lot of those invoices have to be written off, that really should be taken into account when determining the attorney's bonus structure. So instead of being based on billable hours, we base our bonuses based on revenue into the law firm. And frankly, it sounds a little callous, I guess, but I don't really care how that revenue is generated by that attorney. If they generated through presentations or billable work for clients or flat fee work, but it's really about the amount of revenue that they bring in to the law firm. And so we set the metrics for our attorneys much lower than traditional, big law firms, 2,000 hours billable a year. Our bonus structure starts out at 700 hours billable collected, right? So it's 700 instead of 18 or 100 or 2,000. The second thing that we do is a little bit differently is that we have our stair steps for when people get bonuses at much more frequent intervals. And so what I saw when I was at a big law firm was that often towards the end of the year, you'd have attorneys doing one of two things. They'd either would be too short of hitting their 2,000 hour billable bonus target at the end of the year. So starting in October, November, they might not be as excited or as willing to take on new projects, because why work long hours when you know you're not going to be hitting your billable target if you're off track towards the end of the year? Or they'll be just over that target and also check out for a similar reason, like why should I be working late at night and putting in all this blood, sweat, and tears when I've already hit my bonus target? And so we have much more staggered bonus levels, right? So it's 700 hours, 800 hours, 1,000 hours, 1,200 hours. So when people are getting towards the end of the year, they can know that if they work hard, they can still make the next level up, if you will, in terms of the amount of bonus they make. So that's one way that we've structured our comp system a little bit differently than a traditional law firm. And then we also provide attorneys with a kicker if they're the ones bringing in the new client to the law firm. So if they're getting out there and they're going to networking events and leveraging their classmate contacts and whatnot to bring in new clients to the law firm, that gets taken into account when we calculate their bonus. So they get a 10% kicker if they're the ones bringing the bonus and the new clients.
Yeah, and Doug, you highlight a few really good points and things that we try and make sure are components of bonus schemes. First, making sure that bonus is tied to the metrics that really do benefit the firm. And so your example of actual cash coming in the door is critical. We see this come in all different flavors. Bonuses tied to meetings acquired or client retention or just billable hours. And so there's different ways you can structure your bonus to be meaningful additions to the business. But generally, one of the things we want to make sure that you also highlighted is that it's also fair and can still be motivating throughout the year, even if the ultimate goal is dramatically missed. We want to make sure that doesn't mean people hang up the cleats kind of through the second half of the year. We want to make sure that it also still incentivizes them to kind of meet the baselines as best we can. But beyond just bonuses, we also have clients looking to set up any number of compensation plans. We see this in profit sharing, we see it in retirement planning, and of course we see it in cash bonus. And some of these plans are employee stock options, cash balance plans, profit sharing, 401k match, equity and non-equity partnerships for our LLCs and LLPs out there, stock issuances, phantom stock issuances, and anything in between and any combination thereof. And this really warrants probably a whole day in itself to discuss this topic, but it can also be spoken with by your lawyer. Thankfully, you have one on this call here, and also benefits plan administrators are very helpful on these topics. But just to kind of highlight some different examples of how we put this together for some of the clients I've worked with, we had an LLC client who really wanted to motivate their employees by both setting up an equity plan and also a profit sharing plan. So one, kind of have them incentivized in the long-term performance of the business, but also let them share in the win for kind of annual excess profit. And so one thing that we did is in order to issue equity, we needed to convert them to a C Corp. So that's what we did. And in order to issue equity, you also need to have a 409A valuation, which is valuing the fair market value of your firm. This needs to be done before you issue any equity to any employee. So that's kind of a critical step there. And what we did is we actually created an option program for them to distribute options on a vesting schedule to some of their employees, so that they retain some of this owner even after they were employees and left the firm, that they would have vested options and equity stake within the company. And the second thing that they wanted to do is create this profit sharing plan. And there are many formal profit sharing plans, which I won't get into in this moment, but what they really wanted to do was create more of a discretionary bonus pool. And if you're looking to create a discretionary bonus pool, there's actually little limitation that you need to have. It doesn't have to be percentage of salary, it doesn't have to be based on seniority. And what we did was we structured it based on much how Doug's structured his on cash collected by his attorneys. We kind of created meaningful metrics for each department and employee population, and kind of set what the baseline achievement should be for those metrics. And that's what we use to define what the bonus payout would actually be for our employees. And Doug, I know, we talked a little bit about kind of long-term planning and short-term planning, and I know you're also working with some longer-term compensation, particularly around retirement benefits. Can you share a little bit of that?
Yeah, I'd be happy to. And when I'm thinking about, compensation and different types of bonus structure and different types of benefits, there's a couple different goals in mind, at least for myself. So one is I want those attorneys to be working for me for a very long time. So I want to be market, I want to be fair, maybe even a little bit better than market, so people aren't looking and taking a look around. So some of the things that we've done in terms of some of our in addition to base salary and bonus, some other benefits is that we have some pretty generous 401k matching for our attorneys. We pay a large chunk of their health insurance. And it's really hopefully sending that message of we really do care about them. We care about them and their long-term health and long-term financial planning. We also provide them with a pretty healthy business development budget to encourage them to get out there and to think like an owner and try to generate revenue for the business and get new clients coming in the door. So not only having that 10% bonus in terms of the revenue that they bring into the firm, but also the budget to go out there and have lunches and get together with people. We're a 100% remote-based firm. We've been like that since 2010. And recognizing that with that, there's additional expenses that come from people that work for the firm that they wouldn't have if they work for a traditional law firm. So we reimburse cell phone coverage, we reimburse internet coverage, we provide a pretty healthy budget in terms of home office equipment. So recognizing that we're different in that way and making sure that the people that do work for us don't have to come out of pocket because they are remote.
And along something we talked about earlier, legal entities, and I mentioned the client that was an LLC that moved to a C corp to issue equity. There's all different nuances between LLCs and LLPs, and all different kinds of corporations, and particularly how it pertains to them managing risk, and particularly around employees. So Josh, are there any differences for different entity types that relate to different types of insurance?
Yes, so for LLCs and LLPs, they need a little bit more robust coverage, just for the simple fact that compared to a corporation, they just have a more defined separation of ownership and management. So just really wanting to protect them in the LLC and LLPs.
Cole, one thing I've struggled with is determining how often to pay out distribution payments to the owners of the law firm, and how often to pay out profit sharing bonuses and different types of bonuses to the people that do work for me, and calculating those. Or is that something you help your clients out with?
Yeah, this is something we get asked all the time of how big can I make my bonus pool? How much can I take as owner's draw and distribution? And how can I make sure that it actually doesn't jeopardize the business? Namely, that I'm not drawing too much or too soon. And one thing that we advise when going through this process is first understanding the constraints of any compensation plans you have or outstanding debts. Some compensation plans like cash balances have minimum contributions as well as minimum contributions. Some plans like 401k have max contributions. And some of these plans can, especially in employee stock options and more rigorous profit sharing plans, can have less wiggle room, with what needs to be paid and when. But really, what we want to make sure is we have a good understanding of what our obligations are, and really kind of what the free cash pool is beyond that. And what we want to do is really make sure that we're distributing money, one, to meet those demands, but also making sure that we can kind of keep the lights on with the business. So a general rule of thumb we're looking to do is after we distribute any available profit, we're looking to keep somewhere between 4 and 6 months of expenses on hand for the business, making sure that we have a bit of a runway to address any changes in business or revenue or lost clients, but kind of giving ourselves a healthy buffer, because really the last thing we want to have happen is find ourselves in a cash crunch where the partners either need to reinvest cash or we need to go to external sources for more capital to bridge any gaps. But of course, these events do happen, and despite our best planning, we might find ourselves in the cash crunch in that we distributed too much bonus or too much cash to partners. And one of the things we recommend is actually always having a line of credit available to you. We don't recommend leaning on this line of credit at all times. It really shouldn't be for business operations because you'll be throwing money away on interest expenses. But to have that line of credit open and available when you need it, so that you don't have to go back and cattle call the partners to reinvest into the business, can really save some headache later. And this really all ties back to having your books in order, having the forecast in place will help you kind of get that line of credit and understanding what the right amount is to reduce the risk to your business in that regard. And that really concludes the prepared content that we had for you today. So, thanks for listening to what we had to walk through. I'm going to flip it over to Jake now because I know he's been collecting some questions that have come up.
Yeah, thanks, Cole. Yeah, definitely a couple questions came through, so let's jump into the Q&A. The first one looks like, Doug, maybe this might be something you can field. Retention is silently a huge factor in cost for businesses, and it can impede growth. Maybe you can talk about, as you were trying to grow your firm, the importance of retaining, the folks on your team.
Yeah, I'd be happy to do that. I think, one of the favorite books I read for managing law firms was E-Myth for Attorneys. And so E-Myth was first written in the 1980s about how to run a successful small business. And then they went back and they did verticals of different industries. So there's an E-Myth for CPAs, an E-Myth for attorneys. And the original author of the book will have a chapter about his original premise. And then the next chapter is an attorney about how they implemented that premise. So one of the big premises in that book is that the best law firm owners will put a real value on their time, not just say, hey, my time is valuable, but say, hey, my real hourly rates, $200 an hour, $300 an hour, and anything below that rate, they'll delegate out to people, but they'll also take that into account when making business decisions. So I think when thinking about retaining people, is really keeping in mind when you have to hire someone new, how time consuming it is to find that person, to train that person. I know for me, there's several dozen admin tasks that have to happen, from ordering the business cards, to credit cards, to getting them an email account. And when you factor that all in, it's often, hundreds of hours of time when you lose someone to go out and find that replacement person and to get them trained up and kind of, incorporated into your law firm and the process of your law firm. So when it comes to retention, I think sometimes it's taking a look at what's market and what's out there, and maybe just going a bit beyond that, in the hopes that they're not looking. And so you're not losing people because you're not only marketing fair, but maybe even just a little bit better than that, or finding other ways to distinguish your law firm compared to what's market. So hopefully you're retaining people for a very long period of time.
Yeah, that makes sense. Thanks for feeling that, Doug. Another one here, maybe Josh can point this your way. I think this is our last question, but someone asked, is there an insurance policy that provides business owners best bang for their buck?
I don't know about a specific policy, but housing your policies together is definitely helpful in creating something that's financially more effective for everyone. So if you have two policies with one person and another policy somewhere else, not only does it become a pain and a hassle to manage, and maybe they're not on the same timeline. Maybe you're doing one in June and then another one in January. So just having some consideration in how you're putting that together, keeping all your policies in one place, and then making sure that the person that you're working with is working for you. Are they going out and taking that to market and making sure that those policies are the best price, or is there anything that they can do? Can they talk to another carrier, and maybe you added a new coverage line? Can they put a package together that'll really suit you? That way they can help reduce your cost.
Cool. Thanks, Josh. Those are the two questions that folks submitted throughout. So I think that probably wraps up our time if there's no other questions that folks want to throw in. But everybody, thank you for joining today. Founder Shield Pilot, going beyond bills, leveraging accounting and finance and insurance for growth in 2024. We appreciate everyone jumping in. Thank you.
Thank you to our expert, Doug.
Thank you for having
Thanks,
me.
Doug.
Thanks, Doug.